Ind AS 38. Intangible assets. Intangible asset is an identifiable non-monetary asset without physical substance held for use in production process or in supply of goods or services or for rental to others or for administrative purposes. Identifiability. An asset is identifiable if it is either separable, that is, it is capable of being separated from the entity and sold or transferred either individually or together with related contracts, or arises from contractual or other legal rights. So, an asset will be considered as identifiable if it is separable and it arises from a contractual or a legal right. Guidance on asset that incorporates both tangible and intangible elements should be treated under Ind AS 16 or Ind AS 38. Whether it falls under Ind AS 16 or Ind AS 38, it depends upon which element is more significant. For example, software purchased in a CD. Here, software is more significant. It shall be considered as intangible assets. Next, computer machine purchased incorporating software. Here, computer machine is more significant. It will be treated as tangible asset. A recognition criteria for intangible asset. Intangible asset shall be recognized if and only if it meets the definition of intangible assets and it is probable that future economic benefits will be there and cost can be measured reliably. Next, measurement. Initial measurement of intangible assets. Intangible assets will be initially measured at cost. Components of cost if asset is purchased. That means purchase cost includes purchase price, less trade discount and rebates, add non-refundable taxes, add all directly attributable expenses. It includes employee cost, testing cost, professional fees, etc. But it does not include cost of introducing a new product, advertising and promotional cost, staff training cost, administration and other general overheads, initial operating losses. Next, in case of deferred consideration, if payment is deferred beyond normal credit terms, then the cost of intangibles will be cash price equivalent at the recognition date. The difference between cash price at recognition date and the total payment is recognized as interest expense over the credit period. Next, if assets are acquired by way of exchange. In case of exchange of assets, there are two preferences. First preference, fair value of asset given up and cash paid, if any, or fair value of asset acquired, whichever is more clearly evident, provided the transaction does not lack commercial substance. Second preference, if fair value is not available or if the transaction lacks commercial substance, then record at carrying amount of the asset given up plus cash paid, if any. A transaction lacks commercial substance in future cash flows, that is, risk, timing, and amount, are not expected to change as a result of the transaction. That is, cash flows from newly acquired asset are going to be same as the cash flows from old transferred asset. In such a case, the transaction is said to be lack of commercial substance. When the fair value of both the asset given up and acquired is mentioned, it is presumed that both the fair values are equally evident. In such a case, the fair value of the asset given up is considered as the cost of asset purchased. Next, if asset is acquired by way of government grant, it will be dealt as per Ind AS 20. Asset acquired as a part of business combination. In case intangible asset is acquired as a part of business combination, cost of intangible asset acquired in business combination is fair value as on the date of acquisition. Intangible assets acquired in business combination are recognized separately from goodwill, irrespective of whether the asset had been recognized by the acquirer, that is seller, before business combination. If intangible assets are not separable from goodwill, then recognize the intangible asset with goodwill. If intangible assets are separable but only together with another related items, then recognize the intangible assets with the related items. Example, Two separable intangible assets are identified: a magazine's publishing title and a related subscribers database. The fair value of the publishing title cannot be reliably measured and it cannot be sold without the database. Therefore, the two intangible assets are recognized as a single asset at combined fair value. Next, in case of internally generated intangible asset, if intangible asset is internally generated, if it is internally generated goodwill is not identifiable, that is, it is neither separable nor arises from a legal contract. Also, cost incurred to internally generated goodwill cannot be measured reliably. Therefore, it will not be recognized as an intangible asset. In case of other than goodwill, in case of a research phase, original and planned investigation undertaken, but the entity cannot demonstrate that an intangible asset exists, all expense incurred in research phase will be transferred to P&L account. In case of development phase means the phase that converts the result of research into a marketable product. In case of development phase expense, capitalize the cost incurred in development phase and recognize as an intangible asset only if following conditions are satisfied. What are the conditions? An intangible asset arising from development phase should be recognized if and only if an entity can demonstrate all of the conditions, all of the following conditions. First one, technical feasibility of completion of intangible asset, intention to complete the intangible asset, ability to use or sell the intangible asset, how the intangible asset will generate probable further economic benefits, availability of adequate resources like technical, financial, or others to complete the development exist, ability to reliably measure the expenditure during its development is there. If all the conditions are satisfied, then recognize the intangible asset arising from development phase. Otherwise, do not recognize. Cost of an internally generated asset to be capitalized starting from the date when development phase begins. What are the costs to be capitalized from development phase? What are the costs that need to be capitalized from development phase? All directly attributable expenses need to be capitalized from development phase, which includes cost of materials and services consumed, employment cost, fees to register a legal right, amortization of patents and licenses that are used to generate the intangible asset. But this expenses excludes selling and distribution overhead, office and administration overhead, general overhead, abnormal losses, initial operating losses, staff training cost. For internally generated intangible assets, if it is difficult to distinguish between research phase and development phase, treat it as research phase. What are the items that should not be recognized as intangible assets? Brands, customer lists, publishing titles, masterheads should not be recognized as intangible assets. In case of research and development project acquired as a part of business combination, internally generated intangible assets can be recognized as intangible asset if it meets the definition and if it is identifiable. After recognizing acquired research project, company might incur expense on the said research project in two phases, that is research phase and development phase. Expenditure incurred by self in the research phase will be transferred to P&L account. Next, subsequent measurement of intangible assets. There are two models: cost model, revaluation model for subsequent measurement of intangible assets. In case of cost model, intangible assets will be measured at cost less accumulated amortization less accumulated impairment loss. In case of revaluation model, intangible assets will be valued at fair value as on the date of revaluation less subsequent accumulated amortization, that is subsequent accumulated amortization less subsequent accumulated impairment losses. Fair value must be determined by reference to an active market. If our active market is not available, then revaluation model cannot be used. If active market is not available, then revaluation model cannot be used and the asset will be carried at a cost model only. Revaluation model, frequency of revaluation. If there are any significant and volatile changes, revaluation should be done on annual basis. If there are any insignificant changes, revaluation should be done for every 3 to 5 years. What is the treatment of accumulated amortization on date of revaluation? When an intangible asset is revalued, the carrying amount of that asset is adjusted to the revalued amount. At the date of revaluation, the intangible asset will be treated in one of the following ways. Treatment of intangible assets. Method number 1, accumulated amortization elimination. Method number 2, accumulated amortization not eliminated. First, method number 1, accumulated amortization elimination. Journal entry will be on elimination of accumulated amortization account debit to asset account debit to revaluation gain account. Method number 2, accumulated amortization not eliminated. Find percentage of gain or loss, revaluation gain or loss plus carrying amount divided by carrying amount. Revaluation gain or loss divided by carrying amount, we will get a percentage of gain or loss. Second step, increase accumulated amortization and gross block of asset by above percentage. The journal entry will be asset account debit to accumulated amortization account to revaluation gain account. Next, revaluation to be applied to entire class of assets. If an intangible asset is revalued, the entire class to which that asset belongs shall be revalued. Exception is if there is no active market exists for an intangible asset in a class, then the particular asset will be carried at cost model and the remaining intangible assets in that class can be carried at a revaluation model. Treatment of revaluation gain and loss. How revaluation gain or loss will be treated? In case of first time revaluation, at the first time, if there is a revaluation gain, it will be transferred to OCI. If there is a revaluation loss, it will be transferred to PNL. In case of subsequent revaluation, if there is a revaluation gain, previously also there is a revaluation gain, transfer current gain to OCI. If there is a revaluation gain in case of subsequent, previously there is a revaluation loss, transfer current gain to PNL. To the extent it reverses previously recognized losses in PNL, balance of gain, if any, will be transferred to OCI. In case of subsequent revaluation, if there is a revaluation loss, previously if there is a revaluation gain, transfer the current loss to OCI. To the extent it reverses previously recognized gains in OCI, balance of loss, if any, will be transferred to PNL account. Subsequently, if there is a revaluation loss, previously also there is a revaluation loss, transfer the current loss to PNL account. Next, transfer of revaluation surplus to retained earnings. In case of excess amortization means amortization on revalued amount less amortization on carrying amount if the asset was not revalued. That is excess amortization. Such excess amortization can be transferred to retained earnings. This is optional. When intangible assets is disposed or derecognized, transfer full balance of revaluation surplus to retained earnings. This is not optional. This is mandatory in nature. The above transfers will not take place through P&L account. Next, subsequent cost incurred. Most subsequent expenditure do not result in excess future economic benefits. Therefore, such expenditures are charged to P&L account. Next, expenditure incurred but not intangible assets. The following type of expenditures should always be recognized as an expense but not an intangible asset. That means it should be charged to P&L account instead of capitalizing it. What are the expenses? Expenditure on research, except when it is acquired as a part of business combination, startup cost, expenditure on training activities, expenditure on advertising and promotional activities, expenditure on relocating or reorganizing part or all of an entity. These are will be charged to P&L account and they should not be capitalized as an intangible asset. Next, amortization. What do you mean by amortization? It is a systematic allocation of amortizable amount to P&L over its useful life. Amortization methods: SLM, WDV, units of production method, Methods based on revenue in most cases is inappropriate. In rare cases, can be applied only if revenue is the limiting factor. Example, right to operate a toll up to specific revenue. Amortization period. Period of commencement of amortization. When asset is available for use, amortization can be commenced. Cessation. Amortization should be ceased earlier of the following. At earlier of the following, asset classified as held for sale as per Ind AS 105 are derecognized or asset was derecognized, that is scrapped or sold. Whichever is earlier. In such a case, amortization will be ceased. Next, amortizable amount. How to calculate amortizable amount? Cost less residual value gives amortizable amount. Next, amortization of an intangible asset does not cease when the intangible asset is idle or no longer used, unless the asset has been fully amortized or is classified as held for sale. Intangible asset with indefinite useful life is not amortized but is tested for impairment annually as per Ind AS 36. Residual value. Residual value of an intangible asset in most cases is always assumed to be zero unless there is a commitment by a third party to purchase the asset at the end of its useful life, or there is an active market available for the intangible asset and it is probable that such market will exist at the end of the useful life of the asset. If residual value exceeds carrying amount, then amortization value will be zero. Useful life. Useful life of an intangible asset. In case useful life is infinite, you should not be amortized, but it should be tested for impairment annually. In case of finite useful life, the intangible asset should be amortized. Guidance on useful life of intangible assets arising from a contractual or other legal rights. The useful life shall not exceed the period of contract, but it may be shorter depending upon the period over which the entity expects to use the asset. If the contract is renewable, then the useful life of the intangible asset shall include the renewal period only if there is a supportive evidence that is possibly based on experience that contract will be renewed, any conditions necessary to obtain renewal will be satisfied, and cost of renewal is not significant compared to the future economic benefits expected to flow from renewal. Next, annual review as per Ind AS 8, accounting policies, changes in accounting estimates and errors. Amortization method, residual value, and useful life should be reviewed at each financial year end. If any change, then it should be accounted for as change in accounting estimate. Impairment. Impairment testing and impairment losses are accounted as per Ind AS 36 for an intangible asset with indefinite useful lives. An impairment review is required at least annually. Derecognition. Derecognize the asset when asset was disposed of or no future economic benefits are expected from that asset. Gain or loss on derecognition. How to calculate gain or loss on derecognition? Gain or loss on derecognition equals to net proceeds minus carrying amount. Gain or loss should be transferred to P&L. It should not be classified as revenue. That is, it will be shown under the heading other income.